A very good evening to you. I'm Anindya Banerjee. I take care of the research for Kotak Securities in the FX as well as in interest rates. This is a part of the long series of webinars which we had in the past. And it's been quite a volatile market since we started speaking a few months back. In fact, over the last 1 month or so, Indian rupee has completely changed its color. And in the last webinar where we did, I think it was about where the has the Indian rupee hit its bottom. It then appreciated from the levels of 74 half all the way to 69 half, and since then it has depreciated from 69 half against the US dollar all the way to 71 half. So in this presentation, I'll be taking you through the factors which will have a major impact on the rupee, like China and elections back home, and how those will shape the value of the rupee, and as well as have the impact on the markets over here, like the equity and the bond. So without much ado, let me start the presentation. First, a brief introduction, because this market holds tremendous potential for traders. And how large is this market? People who have been attending my webinars, they will be aware of this initial part. But for others who are new, this is important to highlight the immensity of this market, the size which is there. It's phenomenal if you look at it in global terms. $5.3 trillion every day is traded in the currency market. How big is that, or the size, if you want to understand from any other number? Indian economy annually clocks total GDP of around 2.5 trillion. So the foreign exchange market roughly trades a little over 2 times the Indian GDP every day. So that is the size of this market, and that is the scope. Even in the Indian exchanges, if you look at the size, 66,000 crores, and the year is not over, and it is growing phenomenally. It's about to be double of the last year. It will be, in fact, far higher than 100% mark if we compare over FY18. So that is the growth which we are seeing. There are all kinds of participants in this market, from banks to the central bank to retail investors to even the arbitrageurs and prop traders who are there all the time in this market. So this holds immense scope. Now, why is this market so attractive for the retail traders? Because of three major reasons. One, the margin. So if you can just put 3% money into one instrument and trade, why would you at all consider putting 11% margin in another instrument and trade? Because ultimately, you as a trader in the derivative segment, it doesn't really matter whether you are trading a dollar rupee or a Nifty futures, as long as a few things are met. First, there is enough liquidity for you to buy and sell. Two, it should not be manipulated. Three, uh, that market is accessible. So all those three criteria are met in either you trade dollar rupee or Nifty. So dollar rupee has almost like 1/3 the margin requirement of Nifty, and just SEBI has just hiked the margins on equity derivatives. So that is, again, it's making it onerous for retail investors to trade equity derivatives. So it makes a great case to look at the currency market. You can play this market with a much lower margin. The next important thing, unlike equities where you have a bull and bear markets, and if I was giving this presentation, or making this pitch to you, let's say a year back, exactly, in fact 1 year back, just before the budget, people would have just brushed it aside and said, bull and bear markets, we only know only bull markets, right? So for the last 1 year, I think that point has been drilled into the retail investors. What is a bear market? This is not the first time India has seen a bear market, and for that matter, any markets in any equity market in the world. But I think a lot of people simply forgot that equities also have a bear market, and they can be quite right, when as long as it lasts, right? So that's what we are seeing now. And what has happened because of the bear market? Participation has dried up from equity markets. Just talk to the people around, all the mutual fund agents, brokers. What is happening? Participation dries up always in bear markets in equity. That's always the case. Sun rises in the east, participation dries up in bear markets in equities. You can't help it, right? So, but there is a way for traders. The thing is, in currency markets, there is nothing called a bull or bear markets because let's say the dollar rupee goes from 69 to 74. Yes, that's a bear market for the rupee, but that's a bull market for the dollar. So as long as the market is trending, going from 69 to 74, 74 to 65, whatever it does, people will always trade. And that's what they do. There are plenty of intraday opportunities, plenty of overnight, positional, you name it. So that's why currencies are traders' paradise. And third, longer trading hours. In equity markets, you can trade from 9:15 to 3:30. Here you can trade from 9, 15 minutes before, and you can trade all the way up to 5. In certain currencies on exchanges, you can trade all the way up to 7:30. And probably these timings could get elongated even further in, let's say, in a year's time or more. So you already have longer trading hours. So that gives you more opportunities to trade, flexibility, because you don't have to be there on the screen at 9 o'clock. So you can do all your daily scores and get back to the terminal, and you have the time up to evening, or for some currencies even late evening, right? So these are the three major advantages of this market, why currency derivatives is a place where the trader should be. Now, certain conventions are important to understand this market, is that this market trades in a pair. That's the reason why there is no bull or bear market, because it's always we are trading one currency against the other. So if I take dollar rupee as a reference point, a 74 on the price means that it is 74 rupees per dollar. So if dollar rupee quote moves from, let's say, 74 to 75, then it means that the dollar has gained against the rupee. And similarly, if it goes from 74 to 73, it means the dollar has declined against the rupee, or we use another word called depreciation. Right. So now enough of the conventions. Let's move to how you can access the currencies for people who are not aware that you can how to trade currencies on the Kotak terminal. So just a glimpse, you can access it on the Keat Pro, where you trade equities. So it is there. You can easily create a watch list, and both options and futures are available. And there are 7 currency pairs which you can trade, and options are also there. And now from the introduction, what this market is and the potential it holds, and how to access it on Kotak, we'll move to the next important part, or the juicy part, which is what's really driving the currency. And as I said in the introduction, that China and elections. So that will be the theme of at least, not entirety of 2019, at least for the first half, because the elections are anyway around May, June. So it covers the first half of 2019. First, the global economy. Now, what is happening in the world economy? Now, we have been hearing a lot. You may have heard or read in the press, or in some reports or my reports, that the yield curve is flattening. What it means is that the long-term bond yields, let's say a 10-year government bond, the interest rate which is there, which you can earn, is going down compared to what the interest rates are in the economy at present. So let's say we have taken the example of America. Let's say the 2-year interest rate in America is around 2.5%. The 10-year interest rate, which used to quote at 4, so at one point in time, the 2-year rate was around 0.5%. The 10-year was around 4%. So the spread was almost 300, and so 3.5%, or 350 basis points if you want to use a more technical language. So this 3.5% has now come down to almost like nothing, almost zero, right? It's just two and a 2.5, 2.6 is the 2 year rate, and 2.7 is where the 10 year is. Which means if you give money to the government for 10 years, you are getting almost the same rate of return every year if you give money to the government for 2 years. Now, anybody can understand when you give money to the when you lend money for long term over short term, the risks of on that is far higher. It's not that the government will default. It's just that there are other kinds of risks. Inflation can rise, so your money will start losing its worth, and your currency can depreciate, etc., etc. So uh, that's the reason why in a idle market condition, if you lend money for say long term, it should have a higher interest cost. Now, when does it not happen? Like it is happening now, it's not happening right now, because when the people start thinking that the current rate of interest cannot be kept in the or cannot be maintained in the economy. Why is it that? For a simple reason. They expect that the economic growth to become so weak that the central bank of that country will be forced to cut interest rates in the future. That's why when the difference between the long-term bond deals like 10 year and the 2 year bond deals start to fall quite sharply, it's an indication that the market is saying that economy is going to slow down. So that's what we see in this chart. Initially, the financial market indicator, like the spread between the two yields, started to fall. Now, what we are seeing, the economic data implied by this composite PMI, which is basically a survey of the both manufacturing sectors and the service sectors across major economies all over the world, that has started to fall. So the confidence of of producers, of manufacturers and service providers are falling quite sharply. So will this become a recession, or will this stay as a slowdown? That will depend on a number of factors. One of them is very importantly is China, because that contributes significantly to the world economic growth and world investment growth. What happens to that economy? Now, this kind of decline in the economic momentum which we see in the PMI is having it had an impact on the global stock markets. This the green line is the MSCI World Equity Index. Now this has a huge weightage of America, so that's the reason why you are seeing between Jan and September of last year, this index looked as if it was going sideways, or maybe slightly tilting up, because US stock market kept on holding up as the global stock market kept sliding. So Europe was falling, emerging markets were falling last year, but finally the US market, it succumbed. So what I mean is that what you see in this graph, that the financial market indicator like the yield spread indicated that something is going to be wrong with the economy, and finally the economic indicator said yes. You already saw that you saw that impact on the stock market, as well as between August and December we had a big crash in the global equities, right? And since from December mid we are seeing a recovery, a very sharp one. India is unable to participate now, but because of other factors which we will cover. But globally, there is a recovery underway in the stock markets. Now that is not happening in isolation, because what is countering the downtrend in the economy is what the central banks are doing. You have heard a lot that Federal Reserve has is unwinding its balance sheet, means they are selling bonds, right? So they are sucking out money from the economy. The ECB, or the European Central Bank, uh, uh, for the euro, they have stopped printing money. Even the Japanese central bank is no longer printing money. So then how come the global central bank balance sheet is rising? Somebody has to be printing money, right? And even that's what is indicated by this yellow line and the white line, that some major central bank is expanding its balance sheet, which means they are printing money. So that answer is China. So Chinese central bank is buying hordes of their local bonds, local currency bonds to stimulate the economy because their economy is in deep trouble, and they are trying to infuse as much as possible of money into the economy to keep it afloat. And that's the reason why you are seeing the global money supply, the global central bank balance sheet has started to go up. And that has had a soothing impact on the global stock market. So keep an eye on these indicators because they have a bearing on how the global equity markets will do. So how liquidity economy impacts markets like bonds and equity. So we are trying to understand this, how the interlinkages between an economy, between the bond market and the connection with equity market, and then with the currency, because they are all interconnected. So in order to get idea of how the currency will perform, you have to see the whole thing as a movie rather than piece by piece. Now let's see how the Indian rupee has done in 2019. That's been a little less than a month. And what we see is that Indian rupee is right bottom at the table. This is taken from Bloomberg, and it clearly shows that the rupee has depreciated by close to 2% against the dollar. Now that is a little better than the weakest one, which is the Swedish currency, which is depreciated a little over 2%. So both these two currencies are the weakest one out of 31 currencies against the dollar. Now, why has this happened? One is obviously oil. As oil prices has increased from by nearly 20%, it's more than 20% over the last 1 month. We have seen it had a negative impact on the rupee. Why? Because when oil increases, you have to understand India is a consumption driven economy as well. Consumption contributes nearly uh, around 60% if I consider the household consumption. If I add the government consumption, it becomes almost 70% of the economy. The rest is exports and imports and investments. So that is a substantial portion of the economy. So when you're looking at that, what happens is when oil starts to rise, it acts as a tax on the consumer. So when it acts as a tax on the consumer, he starts to spend less. So that's the reason why it has a negative impact on the economy. So it is inflationary, as you said. So it has a negative impact on flows into the equity market because equity flows are directly linked with what is going to be the growth. And it also has a negative impact on flows in the debt market because inflation expectation starts to rise, bond becomes less attractive. So yield starts to rise, outflows happen. So you see an outflow from bond and equity market when oil is rising in India. Uh, because of that outflow, the rupee comes under pressure. It is very simple. If you understand currency through flows, currency becomes super simple. If you try to understand it through anything else, you can go on analyzing, but it will only lead to paralysis. So this is the simple explanation of why Indian rupee. That is one factor, the oil. The second most important thing is uh, Indian stock markets is trading at a significant premium to the world equity markets. Now, when you quote a significant premium to the world equity markets, like if you take the MSCI data, it goes back to almost like 2004 or 2005, the premium which we are quoting. Now, it doesn't mean that the premium will go away, but the factors which were sustaining the premium, that is political stability, growth is going to pick up substantially because of the structural reforms and low inflation. So a strong central bank, uh, say formalizing of the economy. All these things were factors which was holding up the premium. Now those factors are still there, but elections are around the corner. And there is a big question mark who is going to be at the center after the elections, where we have whether we will have Mr. Modi continue one more term, or we'll get a khichdi sarkar, or as you call is a unstable government. So if it's a khichdi, if you are $1 billion investor into India, you would be safe than sorry, right? So, like what happened in 2004, markets were anticipating a return of or a second term for then late Vajpayee ji. But what happened was he lost the election, and the stock market, if I am not wrong, fell more than 25% in 1 month. And obviously, the Indian rupee depreciated, and the bonds reacted. But uh, they are aware of what had happened in the past. So markets will be like to be safe than sorry. So obviously, with such premium and such risks, and it's not that the other options are not available for FPI to invest abroad. They have other options. We, as Indians, may not have options to go beyond our LRS limit to invest abroad, but they have options. So they have other destinations which they might find attractive, like Brazil, etc., etc. So it's not unusual to see the outflows happen from India. So oil risk and political risk and the huge premium which the equity market is commanding is making the rupee unattractive. And bond market, yes, has space because inflation is still low, interest rates can come down. But because of this political risk, the bond market investors will also go slow, and probably we may see some outflows pick up post budget, because there's a whole big question mark what will be the fiscal deficit in the budget. We still believe it will be below 3.5%, because if the government can push through the disinvestments in the budget in the last 2 months or so. But still the market is going to be a bit concerned. So because of these two or three factors, you're seeing the Indian rupee behave so poorly in 2019. Now the natural question comes is, because of this underperformance, has rupee become undervalued? Now let's see the data. Not really. Now in simple English, without before you doze off by just looking at this term called RER, it simply is a way of saying that how much has the currency, in this case the Indian rupee, has done vis-a-vis 61 other currencies in the world. And we have to also take into account our inflation. Like if the rupee has depreciated by 10% against the 61 other currencies in the world, and our inflation has also been lower than other countries, most of it. So it is seen as that the currency has become more undervalued. So it's kind of a benefit to the exporter. So this is how this model is constructed. And what we have done is we have created a statistical analysis. So we have looked at the the standard deviations and created a Z score. So the more green the bar is, the more overvalued. So like in this case, if you look at what was the case in is now, it is 0.48 here. What it means is that Indian rupee is 0.48 standard deviation overvalued compared to its mean. It's simple English means it is a little bit overvalued still. So it's definitely not undervalued in spite of this poor performance in Jan. What was the case in 2018 Jan, exactly a year back? What the point was, it was around 1.6 standard deviation, so it was even more overvalued. And then dollar rupee, if you remember, was around 63, and uske baad everything is now history. It went up to 74 half. So it's not as overvalued as it was in 2018 Jan, but it's still a bit overvalued. That doesn't mean that it can't get more overvalued. So let's look at the factors which can make it overvalued or undervalued in 2019. So a currency market or a currency is like a pendulum. It is hardly at a fair value. It's always swinging between overvaluation and undervaluation constantly, right? Because there is no one value to arrive at the value of a currency, because it's ultimately a paper currency. It is not backed by anything. So there are a range of values dependent on the variables like inflation, growth, etc., etc., which you can form a range of values. So it keeps on shuttling between overvaluation and undervaluation. So the rupee is right now a bit into the overvaluation zone. So what can make it more overvalued? Simple. If there is more capital inflows, you don't need to be an economist to understand this. It's a very simple thing. It's baniya stuff. If we have more foreigners pushing money into India, we will see the rupee appreciate more than our peers. If more money is coming to India than the rest of the world, so it will become, as per the model, more overvalued. Fine. Now, what could be the factors out of the known ones? Election is there. Let's say the election is a surprise, and Mr. Modi comes back with a majority or a near majority. It's a strong government. So continuation of the policies, flows increase significantly to India. Second, also, and because this is a major factor, you got to have this. So once you have this globally, we see the Chinese, which is encountering a big slowdown in the economy. They are able to give more stimulus, which they are in fact doing now, and that stimulus actually has an effect, and they are able to postpone the problem into a future time. That again is good news from the world. So we have a good news from India, good news from the world. And third is the trade negotiation, which is happening between America and US, which is supposed to end by the first week of March. That actually is fruitful, and both the countries look to bring down their trade protectionism. Great news. So we have best of all the worlds. Money flows to India. Indian rupee becomes more expensive. Indian rupee appreciates against every other currency. Other thing, what can make it undervalued? The swing can be large because it's a bit overvalued now. Political instability. Khichdi sarkar. Khichdi might be a very tasty dish, but it may not be a great dish for if you are long Indian rupee. So this is political instability is a big issue for emerging market currencies. It can deter flows. It will create outflows. And then world, Chinese economic slowdown becomes big, and that has a major impact on global financial markets. Again, so we have a problem in India, problem in the world, both coinciding, a perfect storm, and that also has an impact on the economy. Indian economy is already slowing down. You just look at the data, look at any data, talk to people around you. It is slowing down. The consumption is slowing down. So along that becomes even that actually gains momentum, and the world economy too. Yes, that will cause outflows. So these are the factors. Election, China are the two major factors which will decide which way the rupee swings finally in 2019. So you have to be watching these factors like a hawk. You have to be flexibly positioned to take benefit. Now, how will it impact? Let's see how will it impact. As I said, when you are trying to analyze a currency, please ignore trade. You may be hearing a lot of reports, and you may have all this while heard current account, current account. It's simply insignificant. Let me make that strong statement. Current account is absolute, can be ignored when you are looking at a currency, because current account is simply tracks the how much the currency the country is spending over its income. So if it receives more from abroad, it will spend that much more. That's a simple way to understand things. So currency will be impacted not by the spend. It's not economy that we are tracking. Currency will be impacted by that flows which comes from abroad. So first track the source, then the effect. So it's very important to track the source, track the cause, then tracking the effect. So a lot of energy is wasted on trying to project the current account and effect on it. It's a waste of time. So starting with the capital account flows, which this is the financial account is what we term as the big capital flows which happen to India. So the heads are FDI, FPI. FDI we all know, the foreign direct investment. FPI, the FI, investment in debt and equity. So what we see is very interesting. Let's see in 2017, because we are at an inflection point. 2019 election is very important. China important. Let's say we were talking about this picture, the rosy picture, where Narendra Modi comes back, China stabilizes, inflows happen in a big way to India. Have we seen such a scenario in the past? Yes, it was 2017. So the government had won the UP elections, and that created a big shift in the sentiment, and the narrative was then that this is a precursor to 2019, and it shows that he's going to be back with a big number. And what happened to the flows? Just look at FDI was fine, it's steady, but what really picked up was this FPI flows. What 2016 it was like an outflow of nearly $5 billion. It became 30 billion inflows. There was flows from into the banking system, which is the other. So the total flows into India, just look at this. The private sector flows from 2016 was around 28 billion, jumped to $75 billion, almost three times. And what did the because of which the rupee, obviously it's very simple, it's common sense. If you have flows, what's going to happen to the currency? It's going to appreciate, right? It is simple. It's like school arithmetic. So what was the RBI doing? They were buying dollars because they didn't want the rupee to appreciate so much and create a flood, which the flood of dollar flows was causing, because it will hurt the exporters and competitiveness. There are other issues as well. So they started to buy dollars. How much dollars did they buy throughout the year? $37 billion. Again, just to mention, these numbers are taken from the IMF. So these are calendar years. These are not financial years as you find on the RBI website. These are calendar years. So $37 billion they mopped up. So $75 billion came, 37 they bought. So net inflow into the country, because every dollar you buy is an outflow. It's kind of outflow because who buys dollars? Importers. Who buys dollars? FPI, who are looking to exit out of India. That's an outflow, right? So there's a dollar outflow from the banking system. So even if the RBI is buying dollars, that dollar which they buy, it goes to their reserves. It is not available in the banking system to transact. So it's an outflow. It creates a demand for dollar and a supply of rupee. So it has a negative impact on the value of the rupee and a positive impact on the value of the dollar. See, the currency market is so simple. And what was the net inflow into the country? $38 billion. So $75 billion becomes $38 billion because half of it was absorbed by one entity, which was RBI. So its reserves jumped. And Indian rupee, obviously it appreciated in 2017 from 69 to 63. But if RBI had not bought the $37 billion, it may have appreciated much more towards, say, it's very hard to put a number. Let's say it would have appreciated to 58. So that is the thing. So that is how the flows have an impact on the currency and how central banks use the power to print rupee and buy dollars or sell dollars and infuse the and to buy rupee to have an impact on the exchange rate. And also it has an impact on the rupee liquidity as well and the dollar availability as well. So that's why current account simply ignore. It is, again, as I said, not insignificant when you are tracking. It may, for people who are initiated into FX, who are hearing this, it may come as a shock. This is not a forum to explain you all the nitty-gritties of it. Why current account is something which you can ignore. But I will say just this. What you need to track is the flows from where the money is coming and how much is coming. How much is getting spent. If you are tracking particular industry, it's important. When I'm tracking currency, it's not at all important. So that's all it matters. Now let's look at from India. Let's look at another factor which is important, as I said, the Chinese economy, and it's in trouble. And we have been bearish on China since a long time, since 2014, and that call has proved to be right because of a number of factors. But I'll explain you the Chinese economic model a bit, because otherwise what will happen is you will not get the picture. See what was happening here in China. This is a data from 2002. I've used the same BOP framework to understand the balance of payment, how much of capital flow was coming in and what the central bank was doing. Something phenomenal was happening as the Chinese economy was taking off from 2000 and 90s on. The amount of capital flows into China was completely going up. It was surging because these are so 39 means almost $40 billion in 2002, 2003 $63 billion. Look at the jumps. But what the PBOC or the Chinese Central Bank was doing, it was buying dollars. 2002, 40 billion came. They mopped up $75 billion from the market. So why were they doing this? Because China had a very simple economic model, which is an economic model which has been n number of times tested by hundreds of countries over the last 200-300 years, which is basically what happens is in that you suppress consumption by suppressing the household income relative to the national income, and you start in incentivizing the wealth of the producer. So you incentivize more production than consumption. So obviously if you produce more than what you consume, you're going to save. Then you channelize that savings into the economy through the banking system, which is completely publicly owned. So you build roads, factories, etc. This is a model which gives you phenomenal growth. And when it was autocratic nation with political stability, they created massive growth. So it worked well. Now the element of that is that you have to keep your consumption, the household income suppressed, household wealth, the way the percentage share of the household to the overall wealth in the economy, that will be the percentage will keep on falling, not the absolute number, right? Because the absolute pie is also increasing at a phenomenal pace. Now, one of the elements of keeping the household income suppressed is exchange rate, because households are the biggest importers in any economy. Just look at the things which you consume, how much of imported impact it has. Oil, just see how much of oil can impact. So households were a big player. Now, one of the ways of suppressing household income is to weaken the exchange rate, and that's what the Chinese central bank was looking to achieve by buying dollars in hordes. They were keeping the yuan undervalued compared to the dollar in spite of the flows, right? So because this model worked phenomenally well, because when they bought dollars, they sold yuan. That infused a lot of yuan into the system. And they were also, by buying dollars, they were also importing demand. This may be a little difficult for you to understand how that happens, but it simply means that if you are buying dollars, a central bank, it imports demand from the world economy. So it is acting as a magnet for demand in the world economy. So then this is how China had built its economic model. But 2012 things started to change as the economy started to slow down. Outflows were happening from the private sector. It continued. Just look at the phenomenal pace of outflows. 2018, things have stabilized a bit. Now, as the outflows were happening, Chinese central bank had to sell dollars. Right. So, what is the situation now? Now, Chinese economy has slowed down dramatically. Trade war has impacted it more. Its debt levels are insane, absolutely off charts. 350% of GDP, 42 to 42 trillion of debt in the economy. So, it is still adding more debt. So, it needs to lower interest rate. It needs to infuse liquidity. Now, if you do that, what's going to happen, and that's what it is doing, all the monetary policy moves it has done, the yield or the interest rate which you get as a resident Chinese in the Chinese government bond is falling. It's now almost at par with the American government bond. So if you are a resident Chinese, you will be tempted to put money in dollar bonds, in dollar assets, because the compensation is not there. So outflows, it's natural that you see these large outflows, and as the uncertainty will pick up, China will see more outflows. In order to stop the more the outflows, the more the pressure on the currency, and the more the adverse impact on the economy. So in order to stop the deposition of the currency, they have to sell dollars. If they sell dollars, they start to buy the yuan. That reduces the yuan liquidity in the system. They just need the opposite, because if yuan liquidity reduces, it has a negative impact on the growth. So then they start to infuse the yuan liquidity by buying domestic bonds. That reduces the yields. That leads to more outflows. So it kind of acts as a trap. So China is slowly getting into a trap, and we think that this trap will become big over the next 12 to 24 months. So watch out. It can have a big impact on their currency, on Indian rupee, on the world financial markets. So these are the two. So this with this we are almost about to conclude. This is a bonus chart. Just I'll highlight a point. This is equal weighted index of the Nifty mid and small cap, because we have to understand what's also happening in the equity markets, because the big bearing on flows and the rupee. The bull market peaked. This index is a good way to understand whether we are in a bull run or a bear run. This peaked, and that's the reason why, in spite of the Nifty holding up, you are not seeing that kind of euphoria and flows, and the rupee is simply languishing, because the core of the market is sinking, and that's what is being highlighted in the chart. It's at a channel support where it bounced. If the election goes bad, something happens to China, we can see the support breaks. Once this breaks, it's even bad news for the rupee flows, because of flows, and obviously there's stock market. So keep a watch on this. With this is something which we have covered in the past. You can read through this. Stop loss are important. Averaging is not the right way to go, etc. With this, we move to the interesting part, which are the questions. And we have a number of questions here. I'll just take up from the beginning. The first question comes from Mr. Mehul, who asks, where do you see rupee by end of 2019? Considering the current backdrop of China, because I expect the trade war between China and America to escalate, not because of any it's just not because of the current setup, but because the compulsions which are inherited in that. Means what China wants and what America wants are completely polar opposites. So, and Trump probably will not be in a mood to compromise right now. Elections are still 2 years away for him. So he may go all out and push China to the wall, because American economy is not sinking the way Chinese economy is. So if the trade war escalates, it's bad news for the Chinese markets, Chinese economy, and obviously it has an impact on the rupee and emerging market currencies as well. So that is negative for the rupee. That can drag rupee down against the dollar, so dollar rupee upward. And another factor, as I said, big factor, elections. The current trend is that it may be a hung parliament. If that's the case, because honestly, the opinion polls have not been so right in many of the elections. So let's assume the opinion poll is right and it's a hung parliament, then it's bad news. Then we can see, in that scenario, if I have to put a number, I would say 76 or higher against the dollar, considering the global backdrop. If the election produces a stable government, and China, then also, if China is not a big issue, we can then settle around the levels of 70, 69 kind of levels. But let's say China is no longer a big issue, as I said, the overvaluation part, that we have a strong government, China postpones its problems, then RBI has to step in. There's going to be a deluge of dollars coming in, and RBI may like to stop the rupee around 68, but it's not that they will be successful, because if there is a $75 billion flows, $100 billion flows, we may see it go all the way up to 66 or 65. So it is that year where to put a number. Sitting in Jan, I can do it, but it will be irresponsible on my part. So I have to outline the scenarios, and as we move ahead, let's watch and see what happens. Next question is from, this question I have already answered in my presentation. What are the factors affecting the rupee? Just to reiterate, for rupee, in fact for any currency for that matter, but here we are talking about the rupee, only focus on capital flows and factors which affect the flows, because on a real-time basis, it's not possible to track all the factors. Means how much of FPI flows, FDI flows, banking system flows is happening, right? So we always gauge the factors which can either incentivize the flows or disincentivize the flows. It's a very simple template. You don't need to read 100-page economic report to understand which way the currency can swing. And then you obviously have charts to help you gauge that. Then the next question, outlook, as I've already covered it. Uh, where do we see the USD/INR in the next 1 month? The bias on the rupee is going to be down. Means I expect the rupee to weaken against dollar. I don't see it going below 70 against the dollar till May elections. And the upside, as of now, I'm expecting it to head towards 72 half, probably by Feb end or before the Feb end. So that is a level to watch out. And what will the impact of rupee on higher export? See, the impact of a currency on export when you're trying to ascertain, let's understand this. If you look at the entire exports, you will miss the point entirely, because impact of currency is so micro. It depends on the industry, the company, what kind of exports they're doing, what are their competitors. So I would put it this way: as I said in my presentation, when a currency depreciates, what it affects the consumers, because your cost of living increases or cost of imports increases. So that's your consumption. So a long period of depreciation, you will see consumption as a percentage of GDP will be going lower and lower, and it incentivizes production. So that is China, the tiger economies to a certain extent, USSR, uh, Japan, a number of Latin American countries like Brazil, they have adopted that as a formal model, which I outlined when I was talking about China. Depreciate your currency, cap your interest rate, cap the wages as a ways to suppress consumption and promote production, and then export the surplus to the world. So India doesn't have that as a formal economic model, but coming back to a point, that's how it impacts uh, the economy, rather than looking at what will be the impact of weak rupee, strong rupee on exports. It is better to look at individual companies, sectors. So there is always a stock market trade which is on. Uh, Technical levels. Technically, if you're looking at various kind of charts, let's say a point and figure, bar charts, candle, whatever. The point is, it clearly shows that around closer to the level of 70, there is a phenomenal amount of support. In fact, if you just go to the dollar rupee chart, what you will see that dollar rupee was not able to break above 69. It's around 68.80, but above 69 for 5 good years, 2013 to 2018. Then it broke. That was last year. When something breaks a major level like that and zooms, and it came back, it did not go all the way down to 68.80 or 69. It bounced from 69.20. So it is saying that the dollar bulls got the control. The dollar bears attacked, but the dollar bulls again reasserted their control, because it has bounced from 69.20 to now 71.20, went up to 71.5. So reassertion of control technically is a very important thing. It shows that the bulls are still in play. The dollar bulls are still in play. So the long-term chart of dollar rupee is very bullish as long as it is above 69 on the dollar rupee. What are the best time frames for intraday and how to understand candlestick charts? I would say you can read a book by Steve Neeson. There are other resources as well, but this is one book from where I learned the candlestick charting. Steve Neeson. And time frames, it depends on how you are looking to. For intraday, I would suggest a multiple time frame analysis. So let's say if you're doing intraday, hourly is important, obviously. Then you also look at a 10-minute, and also you consider the daily chart. For dollar rupee, I am talking about. How budget influences the appreciation and depreciation of Indian rupee vis-a-vis other currencies. Budget, because what the traders always want to see is that a government who is able to promote growth without pushing up inflation, because the easiest way to create growth, so it's like if I build a bridge to nowhere, your GDP will go up, but it will come at a huge cost on the future generation. It's a bad debt. Similarly, I can print money and create growth, but that's a phony growth, right? So the traders would love to see a government, through the right policy mix, government along with the central bank, create an environment where growth improves but without inflation. So that's what India achieved after a very, very long time between 2014 and now. High growth, or an environment for high growth, and inflation which is very low. So that's the reason why Indian rupee has done exceedingly well when you look at the basket of currencies, not just against the dollar. Just to leave out the last few months depreciation, the last 1 year because of the oil and other things. So that's why the budget is important. If the government's policies become inflationary, then it is negative for currency. So that's why it is important. That's why people look at the fiscal deficit, how much of deficit they are doing, because that is the way to understand the inflation impact in the future because of higher net spending. Let's see the next question. We have time for two more. So will rupee gain after the union budget? This is something which we covered. As I said, this time the budget may not really have an impact on the rupee because the elections are a bigger factor. So that will be really watched. Will rupee bounce back? See, in Indian rupee, because of elections, Indian rupee cannot bounce back on its own. So it needs the world markets or the world currencies to rally against the dollar. We had seen that kind of a thing over the last 3 days. So if the Asian currencies like the Chinese yuan, Thai baht, and others, they keep rallying against the dollar, obviously the Indian rupee will also appreciate like over the past three trading days. But the scope of appreciation is going to be very limited. As I said, the risks are high because India is a pricey market and with risks over the horizon and very close proximity to China as well. So I don't see much of an appreciation till the elections. I think that's yes, that covers the list. Thank you once again for being here today and being a part of this webinar. We'll be conducting more webinars in the future because a number of events are lined up and it's going to be exceptionally volatile. Thank you.